So as this Zero Hedge article says, someone big was utterly blown the F out. Here's the reason behind today's unprecedented VIX move. And we're going to go to Tim Picciott soon over this, but I'm going to go into the article just a little bit. As it says, there was a bizarre moment this afternoon when in the 40 minutes heading into the final hours of trading, the VIX kept rising and rising, preventing the S&P from doing its sworn duty of spiking higher into the next weekend. And then just after 3:10 p.m. Eastern or 12:10 Pacific, the VIX collapsed, plunging as much as 14 vols from 54.39, the highest print since Lehman, to 40.84, the low for the day, and unleashing another unprecedented stock buying cascade, which almost sent the Dow green. What happened, it says, and you can see the chart there, it says, what happened? As a following chat session between three individuals, which includes a former CME index option trader X, all of whom wish to remain anonymous, lays out, what happened is that the VIX ramped as a major Chicago market maker was caught in the infamous gamma short squeeze, which forced them to keep buying the VIX as the VIX soared. In the process, ending the VIX even higher, only to get margin called out of their position by their clearing firm, puking the entire position I hate that word, while liquidating anything they could and unleashing the VIX selling avalanche and the 700 Dow point rally. Regular readers will recognize this pattern. It is what happened, only not with the VIX by ES back in February 2017, when the Catalyst Hedged Futures Strategy Fund pushed the entire market higher when it itself was caught in a similar gamma trap, and which this January was finally busted for fraud. Below the full chat laying out what happened, and you can see it there. I'm not going to go into all of that. It's just a bunch of looks like people on 4chan talking. Anyway, let's go to Tim here. Tim, I wanted to hear your thoughts on this latest news regarding the VIX. Obviously, it's just I can't even get to the bottom of it. There's just so much craziness happening in the markets and from every angle lately. What do you think?
Well, that one that you mentioned back in February 2017, it's funny because this part's not funny, but I had a client who had most of her money with me, some money with another advisor. Her other advisor had, it was either in that, it was in a fund like that one. There's a few of them that blew up in that time frame, and literally her account went to zero. So everyone there was like maybe 5 or 6 different mutual funds or closed-end funds out there. They all went to zero. Wow. And not to give myself a big pat in the back, but the week before that, I was on my friend Ernest Hancock's show, and he said, what's the dumbest thing someone could do right now with their investments? And I think at the time, the VIX was trading for like 9 or 10. And I go, well, if you're short the VIX right now, that's probably the dumbest thing you could possibly do. And literally 2 weeks later, it did another one of these things where it shot up. But essentially, you've got people who are trading on margin, trading on leverage. And so when these things start, getting away from them, it's sort of like if you're in the casino and all of a sudden, you lose on red, then you bet red again, you double your bet, then you keep doubling your bet, and all of a sudden, eventually, when they say puking out, it's like eventually, you've only got so much you can mortgage, so much you can put on the table, and I believe that that's what's going on here. But to be people shorting the VIX, I mean, that has to be such a dumb idea. Basically saying, especially when we're at these record low levels, which we were previous to all of this. But I mean, the fact that we're above where we're at in Lehman Brothers. I mean, I don't know if we're going to go what you wanted to bring up next, but I know when it comes to the bond market, that's been absolutely insane lately. Let me get to a screen with both of us, and we are testing this out in real. Okay, that one didn't work. Okay, boom, there we go. So we got both of them up there. So right now I'm taking a look at the bonds. We have the 10-year U.S. Treasury at 0.77. I believe that is the lowest ever. I mean, definitely lower than what Obama had. Wow. Take a look at, and it was funny because about 3 months ago, they wanted me to, we're building a home right now. Not because I think this is not financial advice. It's mainly because my wife gave me 2 years to rent. So we sold our home that we bought at the low, and now my 2 years is up. And so I didn't lock the rate in when the lady's like, oh, you should definitely lock it in. And so the 30-year mortgage, what we saw the other day, it was, I believe yesterday was the largest one-day move ever in the 30-year mortgage. So 30 years right now, U.S. Treasury, 1.3%. which is inverted from the 20-year, which is at 1.33%. And then again, so if you want to lock your money up for 10 years, you get paid 0.77. Whereas if you want to lock it up for 30 years, you're at 1.3. And so maybe it's important to maybe ask, let people know like why this would actually happen, because people are probably thinking, that seems absolutely insane, and it is insane. And so the reason why you would have different types of inversions, so to speak, is that if the trajectory is potentially negative, so let's say you think, we are going to go into negative rates, well, then you would rather lock in something today that's positive. Right. And even though it's less, even though you're getting paid less on a, let's say you get paid less money to lock in money for 5 years than you do for 10. Well, the inversion's not super extreme right now. But I mean, so if you get paid more to lock in money for 20 years than you do for 30 years, if people are thinking that eventually everything's going to go closer to negative, they'd rather at least lock that in now. Classic recession sign. It's something that we were even pointing out probably like 8 months ago when, the inversion started happening. I believe in Canada, it's been inverted for, over a year already.
The inversion in Canada actually makes the U.S. look better. It's been pretty bad.
Yeah, and so when you're taking a look at this, I mean, even that we've had all this, all this. Let me see. Yeah, so U.S. mortgage rates plunged to record low. Going to try to get both of us here on the screen again, but now my internet connection, and even though I've got a 500 megabyte fiber cable directly plugged into my computer, now it's freezing trying to go to the article. But we've got, it's utter mayhem. U.S. mortgage rates plunged to record low. And so yesterday was at 3.29% is what closed out at right now. But you do have a lot of people refinancing. So the refinancing is, I'm guessing people are probably using it to pay down debt. And what you saw during previous so-called, I'll say this in air quotes, you'll say this expansions or recoveries, is that people would use those recoveries to pay down debt. You'd have companies that would go and pay down debt. But what's happened the past 11 years is that we've actually exploded the amount of debt we've had, both as consumers, both as companies, at the state. I mean, every single level, you've seen people just debt levels absolutely explode during this recovery, because it wasn't a real recovery. All it was this papered over expansion of the monetary supply. I did go through in my Anarchapulco talk, so I'm not going to go and rehash all this right now. I went through and we talked about how the Fed was actually monetizing the debt. So you could actually trace through the QSIP numbers and actually see how they're buying their own debt right now, which, Bernanke said that they would definitely not do that. And, it's all starting to melt down right now. And this is something where, no one really saw this whole COVID thing, coming out of the blue to be the catalyst. But whether this was going to happen or not, this is eventually going to happen. It's just, this is the linchpin that really kind of kicked everything.
Okay, well, off. Tim, let's go into that U.S. mortgage rate article, if you can get it up on the screen, and if it works. Either way, as the Zero Hedge article says, it's utter mayhem. U.S. mortgage rates plunged to record low. Rates for 30-year U.S. mortgages plunged to a record low on Thursday, forced lower by COVID-19 fears, as the U.S. economy could be nearing recession as investors continue to make a mad dash into treasuries. And again, we've been in a recession for like 12 years now. It's just been papered over. I have to mention that in every video because I think it's important to in context here. But as it continues, it says the average rate on a 30-year fixed rate mortgage was 3.29%, down from 3.45% last week, and the lowest in nearly 5 decades, Freddie Mac said in a statement Thursday. The last time rates were this low, it was November 2012 at 3.31%. A quick drop in mortgage rates could boost home sales, but a fast-spreading virus that is starting to take a toll on West Coast cities could prove otherwise, from business shutdowns to quarantines to a collapse in air travel. The economy is rapidly slowing as people load up on food and masks to weather a possible pandemic. Matthew Pointon, a U.S. property economist at Capital Economics Limited, told Bloomberg that mortgage rates would probably extend a deadline or declines before hitting a floor. We noted on Wednesday that plunging rates had led to a massive refinance boom. And it was only a couple months ago, Tim, that we saw line up for subprime mortgages. I mean, we got the collateralized debt obligations, collateralized loan obligations. We have all of this the packaging. I want to hear your thoughts on the potential of, not obviously it's a hyper localized issue, but when we see things like Los Angeles, when we see things like New York, when we see things like Seattle, and I mean obviously coronavirus doesn't help with this in places like Seattle. What do you think of the potential crash or pop of this bubble? Because it just seems like it's just been going on endlessly forever, and it just doesn't seem to want to let out. But it doesn't make any sense that after all this time we're still seeing this bubble not deflating.
What really kind of struck me is I've had people ask me over the years. I mean, obviously, one of the popular questions that we get asked quite a bit is, what is really going to be the precipitous to, or when do we know that we're in a, the big one, so to speak? And for me, it was when the Fed loses control. Now, I mean, eventually they're going to lose. I mean, I don't even think there should be a Federal Reserve. So let's just point that out there in case people are going to, comment in there. So they're going to lose control. And what I mean by that is, and they haven't done so yet, but they're starting to. And so we saw last week, there was an emergency 50 basis point rate cut. And then even despite that rate cut, the Dow that day was still down 700, still down the next day, down the next day. And so now here you are, the Fed having an emergency 50 basis point rate cut, which almost never happens. The last time it happened was 2008. And the market shrugged it off and still was crashing down. And so when you take a look at when the Fed lowers that rate, all it lowers is the Fed funds rate. Then you have to ask yourself, what is the Fed funds rate? Well, that's the rate that if you go to the Federal Reserve as a lender of last resort, as one of the big mega banks, to borrow money from the Fed. Now, the problem is no one in real life actually does that because there's a big stigma to doing that. So what they end up in real life, what happens is some banks have too much money. There's other banks that don't have enough money. And then the banks that have, let's say 11%, they'll go lend 1% to the banks that only have 9%. And then it's because they have to keep 10% overnight in reserves. All the Fed funds rate is if the banks, instead of going to each other, decide to go to the discount window, but they don't go to the discount window because there's a stigma to doing so. And so that because of perception affects everything else, but it's only really because of that perception, not in actuality that it really is actually that important. And so what the Fed is doing right now, they've got really three options. They can save either the stock market, the bond market, well, actually they probably save two of these. They could save either the bond market, the stock market, or the dollar. You can't save all three of these. And so what they're doing right now is they're obviously trying to save the stock market, but even that, and that's the one thing that's going down, that they're losing control of the most. And so the one thing that they're trying to save is the stock market, and that's the one thing that they're not saving right now at the moment. And so how they're quote unquote saving this is they're printing a whole bunch of money to influence the bond market. So by printing the money and buying up their own bonds, as we mentioned before during the debt monetization, what they're doing with that is they're artificially lowering the rates, as we just showed you guys earlier, the 10 years at 0.77, 30 years at 1.3, insanely low levels. And so that's good for the bond debtors out there. It's not good for the creditors. It's not good for if you've got your money in a pension fund that's paying out bonds. And so it's not good for so far it hasn't been good for the stock market. It's been good for the bond market if you are a debtor, because it keeps this whole carousel going, round and round and round. And then it's obviously long term not very good for the dollar either. And so here we got the Fed, trying to save, all three of these. And really what they could be doing is end up effing it up for all three of them, and they're going to lose everything. And so maybe, let me kind of back that statement up again, because maybe you could have the stock market actually go through the roof, but it might retain the same purchasing power. So let's say, if you sell a share of the S&P 500, maybe it buys, X amount of goods. Well, maybe the S&P goes up 5,000%, but it still buys the same X amount of goods, or maybe even less goods, because because a currency has been eroded, the currency has been devalued. And now I've seen different things, and I did have an article pulled up before where there's a new Fed rule to create a capital buffer tied to annual stress test, and I just have a couple quotes pulled out of here. And so this is designed to simplify the post-crisis capital framework for banks while maintaining the strong capital requirements that are hallmarks of the framework. And you got Federal Reserve Governor Lyle Brainerd, an Obama-era appointee, cast a sole dissenting vote against the plan, saying she believed it would reduce banks' required capital levels and the amount they set aside as a buffer above their regulatory requirements. In a statement, she said, "This gives a green light for large banks to reduce their capital buffers materially at a time when payouts have already exceeded earnings for several years on average." I mean, we've got other articles too where Boston Fed's Rosengren says the Fed may soon have to buy stocks. And so for me, that's almost the most important article we have here. And I don't have it pulled up on screen right now because right before we came on, there's a whole bunch of stuff with our computers that we're having
so many glitches.
So many glitches. And so what's going on now is
in the repost of this, Tim, I'll have it up on the screen.
Yeah. So with the Fed president, Boston Fed President Rosengren saying this, he's admitting that the Fed, either the Fed or one of their facilities, will go through and start buying stocks. So that's what they're doing in Japan right now. So in Japan, they're taking money, taking a keyboard, creating funny money out of thin air, using that funny money to then buy up their own stock market, which is actual fascism that I've been crying about, for about 5-6 years since I've been doing this. Yeah. That's the actual state and corporate merger. If you have the state using their funds to then buy up the corporations, that is actual fascism. So where's Antifa talking about all that? And now you've got the Fed, which is funny. If you go to the New York Fed website, which I was actually on there earlier today, actually they do have one article where one of their top guys is talking about the potential for negative rates. And then they always have articles about, well, we can't figure out why there's all this income inequality. When it's the Fed who are the ones printing the money that goes to the richest people in the world first, and they're the ones who are creating all this income inequality. But now you've got the Fed even coming out and saying, oh, we might have to go buy stocks like we're some banana republic, except we don't even get the benefit of having bananas. And it's like I've been thinking that was going to be like their final desperation move, and now you've got the Fed Boston president saying that they might go buy stocks. I mean, what do you think about this, Josh? I mean, it's almost like imagine telling somebody this 5 years ago or even 2 years ago that the Feds might have negative rates and they're going to start buying their own stocks. I mean, they're probably already through other avenues buying stocks.
Honestly. What's crazy is that we have been reporting on it for many years before you joined WAM as well, and you were talking about it a long time ago too. But John Snyson was talking about it many years ago with us, and we were just talking about how they would try to force rates up, but they wouldn't be able to get them up much, and then they'd end up dropping them out, and eventually they're going to go negative. And back in like 2014, 2015, when we were saying that, everyone's like, "Are you insane? That's obviously not going to happen." Let's rewind. I mean, the Fed dropped rates between 2008 to 2012 around 5.5% to mitigate what was a recession, what continues to be the recession, what has been papered over. And fast forward to today, at the rate we're currently sitting at, what happens when you go into negative, entering into a crisis? I mean, I don't even know. It's at the point where emergency rate cuts, okay, great. What's going to happen when it really comes down to the line here where everything has already collapsed and you can't lower them anymore? What are you going to lower them eventually to 10, minus 10? I mean, it's stupid. It doesn't even make sense. So we're at a point in history where if you told people, say 70 or 80 years ago that this was happening, never mind that. Go back to the 80s and tell people that we'd be in negative interest rate territory, like early 80s. Tell people that. They'd be like, you're insane. That's a conspiracy theory. That's absurd. That's never going to happen. Because remember how high interest rates were way back when. And honestly, we've been warning about this for a while. We showed all the examples. We showed all the evidence, and people didn't listen to us. They called us crazy. They said we're playing Chicken Little. It was all fear mongering. And meanwhile, we're just trying to tell people, stock up, prepare. Insure your wealth. I mean, it's not crazy. And obviously, this also comes down greatly to personal responsibility and individual sovereignty and, responsibility and freedom play hand in hand. You can't have one without the other. Tim obviously is a financial advisor. I am not. So this is all just opinion, by the way. The whole video, all of it's opinion. But with that said, there's more solutions than there are problems. You can check the links below if you wish to work with Tim or become a client of Tim's, because obviously he has had a good success rate, a really great success rate, and even does now, a lot of alternative stuff.
I mean, even now. And so, I'm not saying this to brag, because what we want to do is we want to be able to help people out. And when I was saying this before the market went down, is we want to help people. And so last year we got almost all the upside. And so for people like one of the main comments is like, oh, if we were with you, we would have lost money. But they didn't realize the strategy that we're running. And so last year, the S&P was probably up. So we're in the up market, we're probably going to lag the S&P probably by a little bit. In a down market, we're going to lose nowhere near as much. And in the sideways market will be the only thing that we probably lose out on. But last year we're up about about 25%. This year, most of our clients are still positive year to date, fully invested into the stock market based upon the strategy. Now, the problem is, to run that strategy right now, it's, it would have been a lot better if you guys got it 3 weeks ago, because now, we've got to sort of retool our tactics over here and how we get people into this strategy, because it costs, 200% more to do what we were trying to do just a month ago. And so for the people who got in this, they got to ride it all the way up. And the first time I ever talked about this on video, and I'm not saying this to brag, I'm saying this because people are entrusting me with their life savings. That's a big responsibility. And you can't just go off, somebody, what they're saying. What they're saying now in hindsight. Go back to if you guys want to go to my channel, I have a Tim Picciott, the Liberty Advisor channel, where I've got, videos for over the past 3.5 years. They were Facebook Lives, and I repurposed them as YouTube videos. And so what we had gone through is, the first time I ever talked about this on video was October 3rd, 2018. The first time I ever talked about the current strategy was the day before Jerome Powell said we're on autopilot. So if you were with me back then, you would have lost almost nothing when the market went down in Q4 of 2018. You got almost all the upside last year. And then right now we had positions that went up nearly 200% the past month because of all the craziness that was going on. And so those positions that went up 200% then offset the other general market that was going down. And so, we had some other gold positions too that helped out. And so we run individual portfolios for people, not to make this a big commercial, but people always want to say, what should you do? Well, I basically spent my entire adult life thinking basically this is the moment that we've been preparing for. And okay, if it's not the moment and they're able to get this whole debt carousel, rolled on for another year or two, then okay, our strategy is going to work well in that environment too. Because how this ends is the Fed cannot afford to have the stock market go down, because if the stock market goes down, all the pensions, they're screwed. Because in 2008, the average baby boomer was the oldest baby boomer was 62 years old. Now, what are we, 12 years later? Now they're 74. Now they're being forced to take money out of their stock market. And not only that, is now when these baby boomers pass away, what they used to be able to do, what they could do is they could give their IRAs to their kids and their grandkids, and then their kids could stretch those out for the remainder of their lifetimes. Well, now there's a new rule to help you out. And that new rule that helps you out is it forces the beneficiaries to take out all their money within 10 years. That's a brand new rule on the law, on the books as of this year. Most people have no idea that's even on the books right now. This is the law of unintended consequences. So I'm sounding like a true New Yorker, I guess, with that one. But with this is the government's thinking, okay, well, let's say you got $1 million in your 401k, and now you've got and then you got 2 sons, and both your sons now are going to get $500,000. They've got each of them have got to take that out every single year. It's going to increase their tax rate. The government's going to get more tax money. So they're probably scheming over here like, oh yeah, this is a way we can, get one over on the people. But that's going to create then forced selling in the stock market, which would then create a downward pressure on the stock market. And so how do we counteract this? And so if you're the Fed, you're thinking the only tool in our toolbox is to lower rates, get, encouraging more borrowing, which a lot of the borrowing is being done by the companies. And the companies are then using that borrowed money to then buy back their own stock and creating this whole cycle. But eventually, if you all of a sudden start losing money, or your rating goes from, let's say, triple B down to double B, and now you can't even borrow money because now you're in junk status, it creates this whole cascading effect. And so the cascading effect could come from the terrible demographics we have in America, because now all of a sudden we've got 10,000 seniors a day who are taking out, starting to turn 65, who are taking out their Social Security, taking out their Medicare. We've got nowhere near the replacement ratio to population to be able to ever pay for that. And as soon as and so getting back to what happened in 2008, is we had time. We had 10 years, 11 years for this recovery to happen before the baby boomers had to start taking their money out en masse. Now there's no more time. So now the next time when the pensions go down, they're going to get absolutely walloped by sequence of return risk. There's no way to get out of this. There's no easy button. There's basically no optimistic scenario, I guess, unless you have, gold and silver and Bitcoin. You've already prepared with all these other things, or you're in my strategy beforehand because you're going to make money. But this is not about me. It's not about taking a victory lap, because we're trying to save people money. We're trying to help preserve their purchasing power, and we're trying to make sure they have good retirements.
Well, Tim, there's that old saying, it's hard to free fools from the chains they revere. And that obviously is the case. And not only fools, it's far too often the average person, not a fool, not an idiot, knows what's going on, knows what's happening around them in the world, and are just unwilling to take precautions. They put it off. put it off, and then when everything comes down, that's when they want to suddenly start saving themselves, and it doesn't work out that way. But anyway, make sure everyone that's watching to check those links below and press like on this video, and obviously you can become a client with Tim by looking below in the description. There are options, lots of options.
Like what you see here, don't forget to check the links below. GoFundMe, Patreon, subscribe star. We really can't do it without you. We've been so insanely shadow banned, about 90% at this point, and 95% demonetized. As Susan Wojcicki, the CEO of YouTube, comes in and says that she is shutting down quote-unquote controversial content and cutting out the views on this controversial content by 70%. She's been bragging about it. We need your help more than ever in this battle for truth in information. You guys are what keeps us alive, so we really appreciate just even $1 a month makes a huge difference. If everyone could give just $1 a month, we wouldn't even have to worry about competing against the mainstream propaganda networks. You can also donate to our Bitcoin address on the screen for you to scan if you please, as well as in the comments and description. Liking and sharing makes a big difference as well, and finding us on alternative social media platforms like float.app, that's flote.app, makes a huge difference. We're at Josh Sigurdson as well as at Wham. Float is replacing Facebook, YouTube, Twitter, Twitch, Tumblr, Reddit, and Patreon all in one with encrypted private messaging, and of course monetization on videos for creators, live streams with super chats in crypto, and most of all, no algorithm, because at the end of the day, it's all about reach, guys. This is all about actually reaching people with the message and waking up the public. You can also find us on Instagram, Twitter, Minds, Picciott, all sorts of different platforms. Try to follow us on as many things as possible, because very soon this channel will very likely just be completely deleted from YouTube, and you'll never see us again, and you'll be stuck with only the mainstream networks. Also, come on out and see us at Anarcho Vegas 2020 in Las Vegas, Nevada in July, where such speakers such as G. Edward Griffin and many others will be speaking. You could use promo code WHAM on your VIP tickets and save 10%, as well as buy extremely cheap tickets for just $20.20. You won't find a cheaper conference than this with such amazing names. Check anarchovegas.com for more information on that. We hope to see you out there. And anyway, I really appreciate all of you guys joining us. You make it possible for us to survive in this volatile, propagandized climate. Until next time, this is Josh Sigurdson signing out from World Alternative Media. Find the truth, be the change.
I'm sure you have already changed people's minds in your young age because you're involved, and I like that.
Thank you.